My guest today is Pascal Levy-Garboua, the founder and CEO of Noosa Labs. At Noosa Labs, they acquire small profitable SaaS businesses. So far, they've made 4 acquisitions and ARR is 1.5 million. Thanks a lot for coming to the show, Pascal.
Thank you, Mick.
An entrepreneur at heart, as you are, you have co-founded multiple companies. You've spent over 20 years in the tech industry, launched 2 venture-backed startups. You've been the first executive hired at Checker, and you've also invested in 40 startups with 15
140.
With 15 successful exits. Please try to sum up this period and what made you launch Noosa Labs back in April 2021.
Thank you very much for having me here. I've been in tech all my life, all my career, I would say. I discovered that this was what I wanted to do when I was at Stanford in 2002, 2003. I didn't know what I wanted to do, and when I first saw what was possible at the time, I really fell in love with industry and decided that it was my career. I've been a founder multiple times. I've been also an early executive. I've been an investor, as you mentioned. And so when I was thinking about what I wanted to do next, I had to find something that leveraged my know-how, but also acknowledged who I was, really. And, when I was in my late 20s or early 30s, I thought that I would be like a Mark Zuckerberg type, like super duper amazing founder. And after seeing some of my past experiences, also meeting some amazing founders as an investor, I realized that I lacked something that they had, which was an obsession for a specific problem. And there are some companies that I wish I had created, like Airbnb or Acquire.com, like some marketplaces in industries that I like. But I never found that opportunity or that niche myself. So I thought, okay, I can't be a founder because I won't be a top tier founder. I'm not obsessed. I can't be obsessed for 15 years about the same problem. I can't be, being an executive in a company is something that I did. But it was really emotionally draining for me to do that. And I was incredibly lucky and fortunate to do that at Checker, but I didn't feel that it was I had another one in me. And being a full-time investor, I tried that for a year in 2019 when I was still in San Francisco before leaving to go back to Europe. And I realized that it was one of my worst year of investment. I had FOMO all the time. I made some of the stupidest mistakes. Like, in a way, time is not good. The more time I have, the less good investment decisions I make. And so I decided, I realized, okay, what am I good at? I'm really good at, I'm not really great at 0 to 1. I'm good at taking something that is kind of a goodish idea and bring it to the next level. That I'm really good at, and I can be uniquely good at because I can think like a founder, but have this execution mindset that is rare. The second thing is that I like seeing multiple things. I like the idea of problem solving on different types of problems all the time. And so I felt I had read, I had discovered Constellation Software when I was at Checker, and we were trying to partner with vertical SaaS businesses for Checker. And I was a little bit obsessed with a model. And I said, maybe this is a right model for me. This is perfect. And so I initially had another idea for a serial acquirer. I had another thesis, trying to buy bigger SaaS businesses, more vertical SaaS, with a fintech angle. And I've talked to hundreds of companies in Europe with that goal in mind. But I realized that what I was going to buy was going to be not very big. That because I would need other investors, I would own a small percentage of a company that was actually going to build that company. And I said, do I really want to have a burden of having investors from the get-go to buy a small company with very little profit? I mean, not really. I mean, what if I had followed what was going on with at the time MicroAcquire, or now acquire.com, and I said, maybe I should just buy small stuff. And so I had bought a small SaaS business, my first one in July of 2021, as a testing ground, I would say, while I was still pursuing the other thesis. And I realized that this was actually the right thing for me. So I bought one and then another one, and eventually we bought 5, not 4. We bought 5. We just operate only 2 today, and we can talk about that later.
Okay, so I want to elaborate a bit with some of the things you shared. You saying you're not this super duper Mark Zuckerberg type of guy. Like, for how long it took you to realize that? Was it after those meetings with those who were like this, or how was it like? Because it's never too late. I mean, keep searching for this passion, this problem, which.
But I mean, a few things. I think that when I was a checker, first of all, I discovered what was true product market fit. And when you discover what is true product market fit, you learn something about tech. I've been in tech. I've been in different companies that had some success or some moderate success or whatever. And there is nothing like product market fit. And when you're in it, it's amazing. It's an amazing feeling. It's great. At the end of the day, I mean, having this high of finding a product market fit is incredibly rewarding, first of all. But I don't, when I was talking about Mark or Ivan Zhao from Notion, or even Daniel from Checker, I mean, it's just about loving a problem set so much that you want to solve that problem for 10, 15, 20 years. And I know who I am, and that's not who I am. And so initially when I was younger, when I was again, I'm 45 now, but when I was in my 20s or early 30s, I thought that the goal was to be that. But I'm not sure. I mean, and you need that passion. I mean, you can see that in a way when you're comparing companies like Dropbox and Box, where the Box founder is still passionate about what he's building, where the Dropbox founder, he seems completely checked out. And the reality is that, sure, the Dropbox founder is maybe richer, wealthier than the guy from the founder of Box, but the Box founder seems to have a lot more agency or more fun in what he does. And so I just feel that at the end of the day, it matters to like what you do for a long time. And I know who I am, and there are very few areas that I would be like that. And again, when I was mentioning earlier, I would have loved to be the founder of Airbnb because I love traveling. I love solving problems around travels. Or I would have loved to be involved in Acquire because your customers are founders, and I like that idea. And in a way, I like businesses where my customers are founders, and there are not that many of those. So, investor is one of them, and I realize that this is not necessarily what I wanted to do full time. So I'm still part time. I'm a venture partner at Long Journey Ventures, but that's not my full time gig. And when I think about what I'm doing today, I think it's perfectly fine, and it's the first time in my career where I see myself doing this for a very long time, and I don't want to stop. In a way, even when we have tough years, I don't want to give up because I don't want to change job. I like what I'm doing. I really like.
So you now in 2 months you're having this 4-year anniversary of Noosa Labs. So we can say you're happier. You're having more fun than ever.
Yeah, I mean, it's the first year was was a little bit odd because I was not very serious about what I was doing. And the last 3 I have been more serious, and so I mean, it's a journey, right? I mean, we've had some tough times. We've had some years that were a little bit like meh, but I don't know. I mean, I like the team. I like what we're building. I'm excited about what we have to do. It's a very unsettling time because of AI and all the changes, and the fact that we're not at all in a phase where we can expect the next 5 years to be like the last 5 ones. So it's very scary. But I love being in the trenches. I mean, I'm I like what I'm doing, and I like who I'm doing with. So it's great. Yeah, yeah, yeah.
And again, as I don't have those lessons, you're a bit older. Do you think too many people are so-called like they're forcing themselves to do those big things because it's extractive, there's a high prestige, you can become wealthy, but obviously there is no guarantees. So what's your thought?
I think that it's all about trade-offs.
Mm.
Um, I would say two things that are a little bit contradictory to one another. On the one hand, I think that with AI and the speed at which some companies are growing and all that stuff right now, it higher the stake. Even for me, I was at the end of the last year. Last year was kind of a lull. We didn't acquire anything, or we had some growth, but it was not spectacular compared to my plans, at least. And I was like, okay, I mean, I like what I'm doing, but I don't want to screw around and have another year like the last one, right? It was not great. So there was a feeling that what I had to do had to matter, because they are, again, with AI and some of the growth that you're seeing in some projects, there are real trade-offs, right? I mean, you have Elon Musk doing five $50 billion companies at the same time, and I can't just screw around with my $1 million ARR company, right? So there is that on the one hand. On the other hand, when I look at my path, I decided not to raise money initially, and to start with my own money, learn the ropes, learn what it means to do this business, and then eventually maybe we'll raise and we can go to the next level. I mean, by doing so, I go much slower than if I had $5 million of equity and $10 million of cheap debt to deploy. That's for sure. But do I think that I've learned a lot by going down the path that I have been? Yes. Did I want the pressure involved behind a $15 million cash and debt raise 4 years ago when I had my third child after an 8-year hiatus? No. So I think that when you're older, if you're honest with yourself, you need to understand what are the trade-offs. And the trade-off for me was I wanted to learn a job that I wanted to do for a long time. I wanted to do it without the pressure of deploying capital, and I wanted to learn. And that's where I am. And so if this year goes well, if we manage to make the acquisition, create the deal flow, grow the business that we have, then I'll be happy at the end of this year to raise money, to deploy more capital, and to go from 1.5 to 10 and 50 plus million ARR, and with crazy EBITDA margins. But it will take time, and I needed this time, and I don't regret having that time, frankly.
So can you please give me the timeline of the acquisitions? What type of businesses have you bought? And maybe we can go one by one, and maybe you can maybe share like why did you decide to acquire this specific business? What was the reason behind it?
So initially, my thought was the following. I said, okay, you have these businesses on acquire.com that are doing around 10-ish K in MRR, so between 120 and 150K of ARR, that are very profitable because they don't really really relying on SEO mostly, um, and they are cheap because there are not that many buyers for them. And so I said, okay, let's buy one. So we bought the first one, which was kind of a WhatsApp bulk messaging Chrome extension. It was called WA Messages. Um, it was doing between 8 and 10K a month in revenue when we bought it. And we bought it and we grew the business. We took over, and it was our first acquisition. So
How much do you have to pay for this type of businesses? You said
this one we paid around 2x, 2x revenue, something like that. So we paid cash upfront, and so we did that, and then that was our first acquisition, and then we did a second acquisition, and it was in July of 2021 that we closed it. And Javier Andre, who's a general manager at Noosa Labs, was the intern I hired to manage the day-to-day operations of that business. And so he started with us as an intern. He was finishing his MBA, and he did an internship with us for 4 or 5 months, and then I hired him full time as my first employee at Noosa Labs. And then at the end, 5 months later, we bought a second business called Eventable, that I also found on acquire.com. It was doing, I think, between 12 and 14K a month. Also, same thing, same idea. And this one, it was basically a way for, it was still in the CRM space, a way for people that organized events, whether it's B2B events or B2C events, to have an easy button to add an event to a calendar. And so that people could not only add this event to a calendar, but also a recurring event to a calendar. So they could subscribe to a calendar, basically. And so it had some nice customers. Shopify was a customer. The Seattle Seahawks were customers, which as a 49ers fan was tough for me, but whatever. Business is business. And so we bought that business. So that was the second business we bought, and then the third. I'm going to tell you the business we bought in which order, and then we can go through each of them if you want.
Okay.
So that was we bought this one in early January, late December 21, early January 22. And then in 22, we bought two other businesses. One, again, same size, I think 14K of MRR, called My Red Receipts, which was basically as an add-on on the Zendesk marketplace, where agents could see whether the email that they had sent as a ticket to their customers had been read or not. So it's a Red Receipts thing. Very simple app. As you can see, all these apps were very simple apps, like basically one feature or a few feature apps. And then a month later, we bought a fourth business, or 2 months later, we bought a fourth business, which was Centric, which was the same idea, same in the CRM space again. It was a countdown timer for email. So you could, if you're doing a promotion for Black Friday, Valentine's Day, for whatever, you want to add a countdown timer for email, you can have ways to do that. And that requires some technology to create the countdown timer so that it opens and it works well in the email setting, which is different than on a website. So we made, as you can see, we made 4 acquisitions within the first year of launch of starting this business. And then what happened is that it was a lot. It was too much. We made a lot of mistakes, and we can go through each of one individually after. And then what happened is that in December of 2022, our first business, WaMessages, was doing really well. We had grown it a lot, but we got a cease and desist letter by WhatsApp LLC requiring us to shut it down because it was doing something that was against the terms of service of WhatsApp. And we kind of knew it was in the gray. We thought it was in the gray area. I thought it was in the gray area. It was not. And so it was a huge blow, but I decided to comply because WaMessages, Noosa Labs is a US company. I'm a US citizen. Like, there's very little value in me fighting against WhatsApp when most of my competitors, because this business had many competitors in the Chrome store, and all of them, they just remove the terms of a store about bulk messaging, but basically their products are still there and they're still thriving. We decided to not do that, to just do something else, and it was a big blow. That took us back, because at the same time, I was actually about to buy a business that was a similar business, but on the OnlyFans ecosystem. That was much bigger, but the founder and I wanted to do a deal that we could afford. And obviously, I couldn't do it. I mean, I said, what if I buy this business and I have the same issue? And now it's about OnlyFans, and I have to explain to my family that I have this OnlyFans business. Like I didn't want to deal with the hassle. So I decided to not do that acquisition, shut down that business, that web messages business, which was at the time, our largest business, and our fastest growing one. And it took, the 2023, the first half of 2023 was hard because I had this blow. But we made our fifth acquisition called Everlart, which was a skills assessment, like a pre-employment skills assessment business, mostly targeting Latin America. It's a company that I found through FE International. The first four, I bought them on via acquire.com. The fifth one was through FE International. So it's a smallish business, but it's a sector that I knew quite a bit through my experience at Checker. And I knew because we had partners in that ecosystem, and I had talked to people in that ecosystem myself as a head of BD at Checker. And so I knew this ecosystem in the US. I thought that the LATAM market was underserved, but it was a pretty significant opportunity. And so that was the fifth acquisition we made in September of 2023. And it's the last acquisition we made so far. To be honest with you, we actually signed an LOI yesterday for a company. So I won't talk about it before it's actually closed. But for almost 18 months or 17 months, we haven't even been close to sending an LOI. So it was kind of a weird time. I would say 2022, we made a lot of acquisitions. We had this blow. 23 we digested this blow, and we really grew Centric, our countdown timer business. And then 24 was, as I said, was kind of a lull. We cleaned the portfolio. So we bought 5. One message we had to shut down at the end of 2022. The second one we bought, Eventable, basically 2 things happened with that one. The first thing is that during the due diligence process, MRR fell by a lot. It fell from 14K to maybe 10K in a month and a half. And I saw it, but I didn't really react to it. I mean, I reacted in the sense of, I kind of asked after the fact to renegotiate the price a little bit. But I felt maybe there's seasonality. Like I was so obsessed with closing the deal that I didn't ask myself the right question, which were, this is a falling knife. I should not catch a falling knife. And this business, when we bought it, it was a falling knife. It had a very complicated code base in a language that was a little bit obsolete, which made every change hard. We didn't hire the right engineer to manage that code base. So that was also a second mistake we made. And then eventually my Javier told me, what about selling it? Just go, because we had this loan, and these loans that I have are quite expensive. And it's the first business for which I had used a loan. And I decided to sell it to our largest competitor. And we sold it for a good price. I mean, we lost a little bit of money, but not that much. We were able to repay the loan 100% immediately, and I was very happy with that. I mean, it was a very good outcome. We were in and out in less than a year. I mean, obviously, it's not a perfect outcome. I wish I told you that we sold it for 10x and we were raking in cash. But when you have a bad outcome, I've learned that you need to exit the outcome very quickly, because these businesses are not super solid. The third one, my red receipts, did incredibly well at the beginning, but in late 22 and early 23, there was a SaaS recession, where you had a combination of two phenomena. The first one was that startups were basically downsizing their team. And since it's a business, Zendesk is a business based on the number of seats, when they're downsizing their team, there's less, you need less seats, and we are kind of a downward effect of that. So there was that. And then the second thing is that every company looked at their budget and says, we're spending too much money on SaaS. Let's remove all the ones that are unnecessary. And we thought, because we had very high retention for this business, that we were a must-have for our customers, and it turned out we were not. And so we lost, over a period of 4 months, for a business that was growing steadily, slowly, that had 105 net retention numbers. We grew suddenly in 3 to 4 months by 40%. And it's a business that doesn't have a lot of growth, because your growth is depending on the growth of Zendesk. You can't grow outside, and it's a feature, so you can't really do advertising for it. You can't do outbound for it. So we were stuck, and eventually we decided to sell it last year, as a way to clean our portfolio, take the loss. I mean, the joke is that I think it was doing 8K of MRR when we listed it, and the joke is that one day after the closing, but before we did the full transition, this business signed its largest customer in self-serve, that added 20% of MRR overnight. And so that's a gift that we gave to the buyer of his business, which bought a growing business for 1x ARR. So he was the lucky one. I mean, you win some, you lose some, you learn. But I'm glad that we did it. I mean, I'm glad so that was the third acquisition. And so we basically, the first 3 acquisitions, we don't operate them anymore. The first one we had to shut down. Second and third, we sold back. And so we operate the countdown timer business, which we are expanding into an email personalization suite. And the skills assessment business that we're also revamping dramatically. And hopefully the next one in a month or so when we close it.
Listening your story, I think when you would not made those 5 acquisitions, buying and selling those businesses, you would have not got the lessons. So within the first 3-4 years, you've learned a lot. And knowing what you know now, would you have done those deals? And maybe looking towards the future, towards the next deals, next acquisitions you're trying to do, what will you not do and what will you do?
So a few things. One is that for the first deal, the WA Messages, we had a clear we bought it. We had a clear plan. It was a beautiful business that was not legal, okay, but it had a clear value proposition. It was a bad product experience. And when I look at the impact we've had by redesigning the product, we learned, I'm glad that we did that one, because it showed us that when you have but you can really turn around these businesses and completely change the scope. So that one, even though it was a blow and Javier and I still have PTSD about it, I would say I would have done that business acquisition every day of the week, because we've learned what it was. The second two, we bought them. We didn't really have a plan. We thought we could do better than the previous owners, but we didn't really know what we were, like, we thought, we had some thought, but it was not very structured. And I think that what I've learned is that if you're buying a business from a buyer, and you don't really, from a seller, sorry, and you don't have a plan for it, you're not going to do well. And so it means that we need to do real diligence and have a plan. And so now, so for Centric, we had a plan. We didn't write it down, but we had a clear plan and we implemented it, and it had really good results. I mean, we've almost 3x the business in 4 years, or 3 years. So it's great. And it's driving most of the profit of the company today. And for Everlart, we have a plan. We have been a bit slower to implement it for various reasons, but we have a plan and we know where we're going, and I feel very confident about it. And so I think that what we've learned, I would not have made the acquisition number 2 and 3 for sure, but mostly because these were businesses that were too small, for which we didn't have a plan. And the combination is a bad one. Now, if you don't have a plan but the business is big, it's okay because it can generate enough profit so that you can leverage it. But if it's small and you don't have a plan, it's really bad. So these are some of the main lessons that we're using today as we think about our next steps.
Being brutally honest with yourself, before you got started with Noosa Labs, did you think it's going to be easier and you're going to be better at this now when you've seen?
Yeah. I mean,
Mm-hmm.
Of course, I thought that it would be much easier than it turned out to be, and I thought that we would be much better at it than we had been. But on the other hand, when I look at, so now we have 2 businesses, and in the first 2 months, we generated nice profit out of them. Like the company is profitable, is cash flow profitable every month by a lot. And I'm like, okay, I mean, the model works. Like, my model, my idea, like, everybody wants, like, buying SaaS businesses, buying profitable businesses is not novel. It's not original. I mean, it's not like I've invented something crazy, right? Even on the world of private equity, this is not super original. The thing that was original in our thesis was you had these small, like 200 to 800, we say, K ARR businesses that are incredibly profitable, 60 plus SD margins, that we can grow and use the cash to redeploy it for either more growth or more acquisitions. And I think that's really the thesis that I had initially. And I think that overall, this thesis has played out. At every point, there was one business that was performing better than the others, and that allowed us to invest in other businesses, sometimes wrongfully, when we use a profit of, for example, the WhatsApp business to fund the mistakes we made on 2 businesses that we eventually sold off. But sometimes rightfully, when right now Centric, our largest business, is funding additional engineering work that we're doing on Everlart. And I think that this is our model. Our model is to deploy capital in growth, in high ROIC opportunities. And sometimes the ROIC you get by investing in product or in marketing. Sometimes you get it by investing in acquisitions. But at the end of the day, I'm glad to have proven that model right.
Okay, the model works.
Yeah.
Let's say you give this another 5 to 10 years. What are your thoughts? Will your focus be the profit or the revenue and the growth? Because and capital allocation wise as well, like what is your North Star with this?
My initial plan was to get, like, if you ask me when I started, how do you consider Noosa Labs a success? For me, a success was, let's do 15 million in ARR and 50% EBITDA margin. If we do that, we have a great business. We have a team from all around the world that has a nice life for which we can do nice cash bonuses. Everybody is happy. I'm happy. The business is big enough so it's interesting, but it's not so big that I have to worry all the time. Like that was my goal. I don't think that my goal has changed a lot. Like, sure, it could be could we create a 500 million business out of it? Maybe. Is this what I want? I don't know. I mean, maybe yes, maybe not. Like, would I be 10 times happier? I doubt. So, like, if it can be bigger, sure. But I'm not looking to build something big for the sake of bigness. Like, if I own, I mean, 70% of a business that throws 25 million in EBITDA and grows 50% a year, I mean, that's a valuable business, right? These shares are worth a lot of money. Do I need 10 times more? I don't think so. I mean, I don't need a yacht. I don't need I don't necessarily want a 20-year-old girlfriend. I mean, I don't want my kids to be entitled. So yeah, I mean, my goal is to build something, to solve problems, to eventually have capital to do other things as well. I mean, if I'm having fun along the way, that's great. That's the goal of it. This is not the reason why I didn't want to go down the VC track was exactly to avoid the lure of always bigger, bigger, bigger. You can go bigger. I mean, that's not what I'm looking for. So I think about my North Star is to still have a business that will grow around 40 to 50% a year eventually and grows organically, grows through a combination of organic growth and acquisitions, and that has ideally 40 to 50% EBITDA margin. If we can achieve that, then I have built the business that I wanted to build.
What are the current trade-offs? You said obviously opportunity cost. You can't go and raise. Obviously, you can go raise additional capital, but you're out of this VC game because this was your decision. But is there any more trade-offs at the moment, or it's all good?
So one of the big change we made is that we're not buying two small businesses. I think that some of the first businesses we bought were too small, and so we tried to buy a little bit bigger ones, so 200K or more, and I think it was a good decision. Yeah, I mean, what are the trade-offs? Yeah, I mean, I think that so far we've used debt. I've invested money in the company. We've used debt, expensive debt. Our debt providers is stopping its debt business, so we'll need to find one. So the trade-offs is I haven't paid myself in 4 years or not much. So there has been trade-offs, right? There has been real trade-offs. But these were trade-offs that I was willing to make. Are there other trade-offs? Yeah, I mean, I think that I'm glad, to be honest with you, to not buy a bunch of $2 to $3 million ARR businesses in an era like where we have today, where you have all these AI thing, where we don't know where the puck is going. I mean, I have money at stake, don't get me wrong, and I'm thinking about that all the time. But if I had bought a bunch of $2 million ARR businesses for high-ish prices, and I have this AI thing that can disrupt either my margin or my business or both, I would be freaking out. So in a way, that prudence has it might be a virtue um, in this era. We'll see, but I mean, I'm not unhappy about this thing. I mean, obviously, I'm a competitive person. I've always been all my life. So when I look at my ARR and I compare to either the previous guests that you've had in your podcast or other people, I mean, I know that I'm clearly not at the top of a pyramid, but on the other hand, my goal is not to be the highest on the pyramid. My goal is to be where I want to be in 10 to 15 years and to enjoy the journey going there. So, the good thing about doing angel investments and venture investments is that it teaches you the virtue of patience and compounding, and to not be the one who eats the marshmallow very quickly, but to be okay deferring eating the marshmallow and eating the second, to have a second one the next day.
And I think you mentioned the pyramid, and I mean we all have those pyramids, but they're all different.
Of course.
Some
Yeah, yeah.
people, it can be very very different. And when we're talking about this wealth and money pyramid, and in your business we have to also include multiples in this pyramid. And when you're going to build this 15 million and 50% EBITDA holding company of small SaaS businesses, diversified, I mean, you're going to be on top of this pyramid.
I agree that if it's the case, I would be it'd be true. It will be true, and I know that. But I tend to really if you're asking me what am I obsessed about, I'm obsessed about, one, not dying in a way, so making sure that we can get there, and two, I'm obsessed about enjoying the journey. Like, this is very important. I need to enjoy the journey, and that means working with people that you like, working on a problem that you like solving, and having and making sure that you're not wasting your time.
I think all very small businesses have to go through the phase of serving this very expensive debt. And when we look at your business, you're at this at the moment. So, how expensive is the debt at this stage?
So the interest rate is high. We bought that. We bought these businesses with a debt of 18%. When we structure these two, it's interesting to see that the two businesses that we still own are the only ones that we structured with some kind of seller financing or earnout. And I don't think it's a. I think it was. I don't think it's a surprise. I think that we should have done it earlier. And now I'm all for all my deals. I'm doing that now because it keeps the founder of an initial business a little bit in the loop. They're not involved. They're not working for us, but they're in the loop. Like, they care because they have skin in the game. And also it improves our cost of capital and our ROIC. So obviously it has an impact on our profits until we pay it back. But I would say that at least for the business we own, we're getting to the end of some of these payments, for example. And so if I look at on a monthly basis, out of all the costs that we have, that is around, it's around 20% of revenue for what we have to, plus the seller financing. So it's a little bit more. It's a little bit more overall. It's like maybe 40% overall. But one is getting to be because we're close to finishing the payment of a seller financing of a larger business. This year it will be less, and it's the last payment.
So, 5 acquisitions so far. How many companies have you looked at? How many offers have you made? I'm asking because trying to understand how many good businesses there are, and what is the reason for the seller actually wanting to sell the business? I mean, how mature are the businesses? And in the beginning of our discussion, we discussed that you've experienced once this product market fit at the highest level.
Yeah.
So if those companies have this product market fit at the highest level, the founders probably would not sell it. So what are you getting into?
Yeah. So I would say a few things. The first thing, to go back to your question, is that, so we have looked at hundreds of businesses, maybe 1,000 now, but clearly in the high hundreds, like Dex, Sim, whatever, all that. We've looked at a ton. The ones that I've actually dove deeper into, maybe 20, 25, not that many. Where I took the time to write a memo, to really go deep into them. And then we've made, so we have this we made, I think, 8 offers overall, and we've won 6.
Mm-hmm.
So one thing is true is that initially every time we made an offer, we won the first 4. And then after that, I became a bit more strict, and I put together a different process where I have to write a memo. I have people in my team reading it, especially Javier, my GM, because he's the one who's going to run the business. So he needs to be on board with this, and he sees things that I don't, and vice versa. So it's a good complement. We're really complementing each other in that regard. So the change is that because this memo is very, very detailed, way more than a traditional SIM. It takes much more time for me to do them. Like, for example, I just signed an LOI yesterday. I think it took me 3 to 4 weeks of due diligence, where I called customers, I called competitors, I did a lot of research. We did an SEO analysis. I mean, it's a very long Notion document with other pages, attachment, et cetera, et cetera. I mean, so yeah, I mean, now there is much more research going into these memos. And so as a consequence, we don't do that many. That being said, last year I met the founder of a PE firm called Mainsail, and what I've learned from them is that he told me that they were talking to hundreds of companies a week, thousands a year, and that they were building a relationship, really thinking about the company over a long run, doing a lot of outbound, and we were not doing that before September. I mean, last year I started doing a little bit of content marketing to trigger some inbound, which has been on and off. But yeah, we started doing outbound in September of 2024. So I hired somebody to help me with that. And we're seeing way more deal flow today than we ever were as a consequence. So I think that we're seeing things inbound because our name is more out there. We're seeing more because we're doing more outbound, and obviously there is a bit more deals in the market today for various reasons that we can discuss. So that's kind of explains how this process works. Now, I want to answer your second question, which was around why do people sell?
Mm-hmm.
And I think that my job as a buyer is to actually understand that, not from a personal standpoint, but from a business standpoint. Basically, what I believe is that if you're an indie SaaS builder, you have a suite of skill sets. And then at some point, you're going to hit a ceiling, like a glass wall, like a glass ceiling. And that glass ceiling corresponds to a thing that you don't know how to do. And our job is to break that ceiling because of a team and resources that we have, that you as an indie founder, you were not able to hire. So for example, when I look at the Countdown Timer email that we bought, they try to do outbound sales, they try to manage deals with enterprise, but they were never able to do that. I know how to deal with enterprise. I know how to deal with their PO process. I mean, what type of product that they want to buy, etc., etc. So we created that product. We created a pricing for that product. We created a buying process for that product, and we have made money from that product. It's something that could the founder have done it? Maybe. They didn't want to. It was not their intent. And so they didn't do it. And so our job is to figure out what are the things that the founder can't do or don't want to do that we want to do. And if we don't see that, then it's a bad sign. Because every founder will tell you, oh, if only we did sales and marketing, it will grow, right? But that's the biggest lie I've ever heard, right? I mean, of course, like if you're doing sales and marketing, it might grow, but it might also grow in a very unprofitable way. So you don't have any idea if it will grow. So no, I mean, what we want is to buy businesses that are growing on their own, and what we can do is through different strategies or because of different resources that we have access to, we want to be able to grow them more than what the founders could on their own. We have SEO resources internally. We know we have great product designers that can improve a product design if need be. We know how to deal with enterprises and how to work with them. Very few indie founders know how to deal with enterprises because they've never met an enterprise in their life as a salespeople. I have, so I know how to deal with it, and so I can train my team to do that. So that's really how we're thinking about these things.
So how have you grown as an investor, as a buyer? You mentioned before the mistake of being extremely obsessed closing the deal.
Yeah.
How is Pascal today compared to 2021, 2022, when you got started and when you tried to do as many deals as possible?
Yeah, I mean, I think that now I'm doing way more diligence and putting a lot of more thought before extending an LOI. And it has kept us from deals because the deals went out before we were able to make an offer. But I'm glad that we have this process. I will not change it. I think that this is the right approach. We can discuss how we can do it faster, blah, blah, blah. But at the end of the day, we need to go through that process. And, we can use AI to help us with some things. But if AI does the thinking, I mean, I think that it's important also that you go through the thinking yourself so that you know in your heart what you want out of a business that you're buying. And it's hard to do that just by reading either a sim or a sim written by ChatGPT, right? It has to come through interactions with the buyer, the seller, sorry, interactions with customers, interactions with competitors, understanding of a market. Like these interactions matter in my mind for what we do, because then we have an intuitive understanding of what needs to be done. And then we can create like a plan, a post-acquisition plan that where the team knows where it's going and we don't end up scrambling.
Do you think there will be a period you won't do a deal for 2 to 3 years? I'm asking because, number one, to understand the market. Do you think there will be a situation where maybe it's because of the AI or something new that comes up? Number one, and number two, that you become so, let's say, good at it that you're only doing like no-brainer deals.
It's a good question. I mean, I think that the question that I have that I haven't solved yet is, so far we could do only small deals because we not because we can buy only small companies, because we can only pay a certain price, right? If I'm funding a business with basically a third equity, a third debt, and a third seller financing, or 60-40, like 60, like 30% equity, 30% debt, and 40% seller financing. I mean, basically it means that I need to have at least 30% in cash in some bank account that I control, right? So either the company or myself. And there's a limit to how much I want to invest personally in this venture, right? So the question it begs is, okay, if tomorrow you raise money or you grow and you have a lot of cash flow, will you still buy businesses that are as small as what you buy or bigger? I don't have a strong, I don't know. I'm not sure. Like, it's possible that we would look more at bigger businesses. But if we have a business that is doing 20K a month and that is growing really well and that we like a lot, I mean, I don't see necessarily why we wouldn't buy it. Initially, my thought was that a good business for us that eventually could get to 1 million ARR, and it would be like the best business we would buy would get there. Now I actually think that I want my businesses to be able to go to 1 and maybe 5 over time. That would be my ideal scenario. I like the idea of buying a business that will grow to maybe 500, 600, and will never grow from there. I'm not sure this is a scenario that I love a lot. Initially, I thought it doesn't matter. It's cash flow. Now I'm a little bit more, I'm trying to build something that has more of a lasting value. Now, in terms of, to answer your question about, is there a possibility that we don't make any acquisition for 2 or 3 years? Yeah, I mean, if we realize that SaaS is a bad business to buy because everybody built their own SaaS with AI and nobody's buying SaaS anymore, then I'm not going to buy the remaining one even for $1, right? I mean, or we'll buy them for pure cash flow, like it will be financially engineering. But yeah, I mean, I'm not going to do that. Maybe we'll buy HVAC installers like everybody else, and we'll use the cash flow of our existing businesses to diversify in a true holding fashion. Like, who knows? But I mean, I would say it's possible. If it happens, there's really something bad happening in the market. I don't think, I do agree with the idea that it's a little bit of a tail business like everything else. But I don't buy the fact that we are like Warren Buffett and there is only one deal per decade or that really matter. Like I'm not sure that this is true.
So
Which is the opposite of venture. Venture, like sometimes there's only one deal that matter, and it's, but not in. I don't think it's the case for us.
what needs to change or improve to achieve this 15 million in revenue, 50% EBITDA, or what needs to be true for you to achieve it?
So this is our plan, and this is our hope. First of all, this year we need to grow more in order to be able to pass a certain threshold, I would say. And the goal is to be in a position where the first two the two businesses that we still operate are growing and growing well, and we've proven that we can grow them consistently, and we can sometimes expand their scope. That we make at least 2 acquisitions this year to show that we can build an acquisition engine, both through content and outbound, so that we have an engine for growth. Like last year, if you had given me $5 million, I would not have been able to deploy it because I didn't see any business that was worth spending money on. So I think that my goal this year is to grow way more as a combination of operational success and acquisition success, almost as a proof that we understand what we're doing. I also want us to build media assets around our businesses. That's very, very important. I believe that SEO is going to change, maybe, and that we need to own media channels, communities, basically, that would allow us to have a place where we can have access to our to customers that we only own. I think this is going to be very important for every businesses, even more SaaS, and we need to do that. So that's another big area where we're investing our money this year, to either buy or partner or create these assets. And then if we do that and it works, and if AI is not making any white collar job obsolete, and uh, and so removing the need for software, then I think that we will raise money at the end of this year, to go from 2.5K of ARR run rate to probably 8 to 10 in 3 years. And then from there, the business is self-funded. Then hopefully the business works in such a way that the profit that we're making every year can fund our growth indefinitely. And then in a way, we've won the second phase of a deal, which is to get to a point where you're self-funded and you can still grow and be big enough.
One last large question, then we have two quick questions, and then that's it. I wanted to ask, you've invested in 140 startups.
Yeah.
You have this rare experience of doing this. How did that experience help you become a better SaaS acquirer?
I mean, I think that the interesting thing that I have is that I've seen, as an investor, thousands of founders and thousands of businesses over the last 10 years, like thousands. And I followed both the businesses that we've invested in and some of which I didn't invest in. And I've learned by observing what happened over, in my case, 13 years. So I've seen companies that did incredibly well where it was not expected. Companies did incredibly poorly when it was not expected, or companies at some point hit a plateau and they can't grow. And so I think that it helps me because my internal database has a ton of data, and that's valuable. Now, the difference is that, when you're talking to a debt person, they're obsessed about losing because, if you're a lender and you're giving an interest rate of 10%, the best you can get is 1.1, whereas the worst you can get is 0. And so there's an asymmetric risk that they're bearing because they can lose all their money, whereas they can only grow 10%, right? In this case. Whereas in venture, I mean, there is 1 year where I invested in, I think, in 12 companies. I have 11 zeros, and I invested in Checker, which is, I think, I don't know, depends on what's the last valuation, but it's when I sold this position, and it was 200x or 300x, right? So who cares about the 11 others? Like, personally, I'm not proud of it. I said, fuck, I mean, I really sucked in 2014, but financially, who gives a shit, right? I mean, I did 14 investments and or 12 or something like that, and one did 200x. I mean, I'm 20x on the year, right? Even more actually, because I invested more in Checker than in other businesses. So my point is that it doesn't really matter. But in my business, in Noosa Labs, you can't think like that. You need to, I think that the right approach is you need to grow these businesses. You need to get them to a point where they can be $1 million businesses or more. And if after a year or 2 years, you realize that a business has flawed that you didn't see, you need to cut it very quickly, decisively, and just move on. And that's something that you can't do in venture. In venture, I still have companies that I invested in 2011 or 12 that are still in my portfolio. And I have no idea if they're doing well or not. But I mean, I can't orphan them, right? I mean, I'm not counting on them for my retirement or anything, but who knows? I mean, some of these companies are valuable. I mean, I invested in Notion in 2013. I mean, it's probably one of the most valuable kind of investments I own. And it's 12 years in, right? So
Okay, Pascal, it's been a lot of fun. I want to do it again 1 year from now, and all the way when it's going to be the day, the 15 million day, because then we have the whole journey.
50, not 15, 50.
50.
Yeah.
Okay, I all the time understood
No.
5.
50.
Okay, another level.
Yeah, another level.
So, 2 quick questions. Your favorite book?
I don't know if it's my favorite, but I think that the book, I typically like fiction. And so most of my favorite books are French books. But I would say that to be useful to your audience, I would say that the book that I think has had the most impact on me is Guns, Germs, and Steel, because it's an amazing book about human nature and what it is to be a human being at an intrinsic level. That I think that and it's really well written. It touches many dimensions. It's it's clearly one of a book that I know that I will reread every 10 years, because I will glean something new out of it.
And last one, the best investment advice you've ever got?
The best investment advice I've ever gotten as a venture investor is what I just told you earlier. When you do a venture investment, remember that you can only lose 1x, but your upside is uncapped. And so that realization, and the realization that you need to only invest in things that can be huge eventually, is the right investment. The worst investments are ones that you do because you think that you'll do 10x or 5x or whatever, because these 5x or 10x never materialize. There is no market for companies that drive consistent 5x or 10x outcomes in startups. And so when I look at my returns, it has either been like double digits plus or triple digit, or whatever, like meaningless.
Okay. Thanks, Pascal. Thanks a lot for doing this. We will talk soon.
Sure. Thank you, Mick.